When the world gets weird and the bills get thick, you call on Clint and you feature Dick. One talks numbers, the other talks slick. Two dads, one mic, yeah, this could stick. Clint's crunching figures straight to the point. Dick's just here to laugh in the joint. It's the Clinterific Show, featuring Dick. Dick's quick with a joke, Clint's got the math. Together they'll balance your checkbook and your laugh. They'll talk finance, fun, and fatherly fails, with liquidity dreams and 401k tales. So grab your coffee, join us a ticket, the Clinterific Show, featuring Dick.
I'm gonna try not to do that too often, but I still got some
I'm
stuff.
fairly positive that it's supposed to be on this, like on the side right here, yeah. But yeah, I'm not 100% positive. I don't know.
So like I know mine, like
I believe it's supposed to be kind of on an arm, kind of like what you're doing. But that would mean it's kind of held like right here in my face. You know.
So you see this dial here?
Yeah, I've got a dial too. But yeah, mine is. I think I tilted it away too far now. Okay, that I think that's the direction that I'm going to go with it. Okay, so it seems to be picking up my voice adequately. You are not coming through auditorially now.
Yeah, back.
There we go.
No, that was. Clint, can you hear me now?
Yes, I can hear you now.
Sorry. No, I had a thing because I bumped the cable on my mic, and so it came unplugged.
Yeah.
And then it was picking up through my
tip.
Yes.
Ah.
And
nice.
That's never a good thing. Yeah.
Well. Anyway, welcome back. Welcome back to episode 18 of the Clinterific Show, featuring
Dick.
Yeah.
Wait, which way are you? You're on this side. Am I gonna be on that side?
You're on this side of me, so I'm pointing at you on the video.
Gotcha.
The man, the legend.
You know it.
Yeah. So yeah, we've had a bit of a hiatus with tax season and spring break.
Spring break, yeah,
nailing us. So
yeah. And I decided to take spring break off to hang with my kids. What a mistake that was. Because I got sick, not because I don't like hanging with my children.
No, I get it.
But I got sick, so
yeah, I've been doubling up on my zinc dosages and vitamin C and vitamin D and you know all that.
You can never get enough vitamin D.
Exactly. Vitamin K 12 or whatever that junk is.
I think it's B12.
Vitamin K, the unsung hero of the clotting world. It's a group
Nice.
of soluble vitamins that help your blood clot and keep
Okay, so for those of you out there that doubt whether Alexa is listening to you at all times.
Well, that was Alexa.
Yeah.
Nice.
Yeah.
Just call my name and I'll come running. Not literally, of course. I only start listening when you say my word. Otherwise, I'd be overwhelmed by all the fascinating conversations about grocery lists and what's for dinner.
It's funny. We were just talking about grocery lists before you started recording. How did she know?
What's happening? Because apparently I said some kind of keyword that I didn't know that I had said. So
you really screwed the pooch there.
I did. So yeah, we are coming back, and we're going to hit the ground running with a real doozy of a topic this week. So
you should tell Alexa red alert.
Red alert, yeah. Wait, why?
Just do it. It's funny.
Hey, Alexa, red alert.
Aye, Captain.
Did not do it?
Yeah, it's doing something. I think I just got shot.
Balls.
It
It's
just had
supposed to do a Star
it
Trek
said,
thing.
It said aye, aye, Captain, and then went.
Oh. Yeah, that was it.
Oh,
Yep.
okay. I got
Yeah,
you.
from Star Trek. And you can also, another one you can do is you can ask it for tea Earl Grey hot, and it'll tell you that the
Live long
the
and prosper.
synthesizer is broken right now.
Live long and prosper.
That's I thought that was the shocker.
No. This is
Never mind.
the
No,
planet.
this is
It's planet Vulcan.
Vulcan.
Yeah. Watkins.
That's a gang sign. Sorry. No, Watkins.
Yeah. Oh man. Yeah. So anyway, this week we are going to talk about the ever alluded to Big Short movie and
Oh,
the actual real world financial implications and what actually happened and the follow up to that. You know, whether when anybody went to prison or there was any significant changes in regulations to make sure that it doesn't happen again. Spoiler alert, you will be disappointed.
oh.
So,
Or encouraged.
yeah, exactly. So, have you seen this movie, Mr. Dick?
I have not seen.
You have not seen it.
I have not seen. Hang on, let me look up the IMDb because I'm
It's
thinking
a
in my
great
mind.
movie. It's one of my favorite movies that is loosely based on real events.
Okay, this isn't the movie I was thinking it was.
Okay.
Oh, I think it was Get Short. Was the one I was thinking of.
Oh, okay.
So I thought Danny DeVito was in it.
Oh, no. It's Steve
Get
Carell,
Shorty.
Ryan,
Yeah, my bad.
Ryan Gosling,
Yep.
and Chris.
Christian Bale
Christian
and
Bale.
Brad Pitt.
Yes. Oh, I always forget Brad Pitt's in it because he's kind of a weird little offshoot character that he doesn't look like Brad Pitt normally looks.
How's that different from real life?
Well, it's even more drastic from real life. So,
Okay.
do you have any idea? Because I'm trying to gauge how much I'm shocking you with what I'm about to be going into. So, what do you know about the financial crisis that happened in the late 2000s? If anything,
I know that a bunch of banks and large auto manufacturers went bankrupt, and Barack Obama wrote them a check.
so yes.
I don't know anything.
And yes and no. There's a lot to unpack.
Oh.
So, to start, we're going to have a little bit of an educational explanation of some things that you'll need to know later. So, what happened was banking used to be boring. It was basically
It's
just
not
a
anymore?
place where people stored their money. There was not a lot of opportunity to make money off of it.
You say used to be, like it's not anymore. Like,
Well,
I thought that's what banks were for.
It is significantly more complex and has significantly more opportunities for money than it used to. So,
Wow.
So
I'll have to quit my job as a lion tamer and take up something exciting like banking.
yeah, listen. So there's three specific things that you need to understand that led to
Hey.
the majority of what happened in the financial crisis. And trust me, it probably, even after I explain this as much as I can, it's still probably not going to make 100% sense. And if you figure it out and you understand it the first time, then go start investing, because you understand things better than I do. Because I've been researching this topic, and I have watched probably at least 25 to 30 different YouTube videos talking about the analysis of what the specifics are of what happened in this 2007 to 2009 financial crisis. So point number one is what is called a mortgage-backed security.
Okay.
So a mortgage-backed security, or an MBS, is defined as a financial institution's bundled individual mortgages into a singular investment vehicle. Investors purchased these for yield generated by homeowner mortgage payments. Okay, so I know that's a lot of big words, but what it is they said, okay, we're not making a lot of money off of an individual mortgage. But if we package them, so if I take Dick's mortgage and Clint's mortgage and 500 other mortgages that I have housed on my books or balance sheet, those are two terms that you'll probably hear regularly when referring to this. And a balance sheet is just essentially something that you own. It's something that you own on your books. So it's an asset. So you have 500 mortgages. Well, you don't want to hold the risk for that. And you're looking at a way to make a good yield on a lot of money as a big bank. So you go to your corner bank there in the town that you live, and they have 30 mortgages on their books. And then you go to the big ones like JP Morgan and Chase and banks like that, and they've got thousands on their books. So what they did was they created something called a collateralized debt obligation. So debt obligation is just a mortgage.
Okay.
It's another word for a mortgage. And there's other types of debt, but the ones for these purposes were mortgages. So investment banks, aka your big banks, AIG, Chase, all these big ones in Wall Street, took lower rated, high risk tranches of various mortgage-backed securities and repackaged them into new securities. Ratings agencies systematically rated these new bundles as AAA prime, which means low risk. So the way that these mortgages are rated are they start out as Bs, then there's triple Bs, and then there's A's and then triple A's. A is the best, or triple A is the best, and then decreases down to A, triple B, and then B. So there's more money to be made because from an interest rate perspective, somebody who is a higher risk has to pay a higher rate of interest. So think of it like a car loan. If you have a 400 credit score and you go buy a car, you're likely going to be paying 15 to 20% on your car loan. If you have an 800 credit score, then you're likely going to be paying a 4 to 5% interest rate. So what they do is they hedge their bets and they say, okay, well, we want enough people paying their mortgage that we're going to make this amount of money spread out over the average of all of the people who have borrowed money for us for making their car payment. So we're assuming if somebody has an 800 or higher, that only 5% of them are not going to make their payment each month. Whereas if it's a 400 credit score, then 30% of them are not going to make their payment each month. So we have to charge them more to cover the spread. Does that make sense?
Yes.
So it's the same thing with the house. You get a better interest rate the higher your credit score is.
Right.
The worse it is, the lower it is.
Sure.
So the problem was when they repackaged all of these Bs, which are the worst, they repackaged them with triple A's. But they were not triple A rated mortgages. They were Bs. But they were being sold as if they were triple A rated mortgages because they were collateralized. So what that means is that there was just a bunch of different mortgages inside of one package. So there was a lot of Bs, triple Bs, A's, and triple A's. But the way that it worked is essentially the payments come in and the money fills up the A's or the triple A's first. And essentially, like if you looked at it like a bucket system where when one bucket fills up, it spills over into the next bucket. So the assumption is the triple A's fill up first, spills over to the A's, spills over to the triple B's, spills over to the B's. The B's are the last, but they're treating it as everybody inside of this triple A rated CDO is paying. Well, what happens when the B's and the triple B's don't pay? That's what you'll find out. So, the reason that the movie is called The Big Short is because, and this is not a new thing, they kind of talk about it in the movie a little bit. If you ever get a chance to watch it, it is an excellent watch. But they talk about it in the movie like it was a brand new thing that the Christian Bale character came up with. And it's actually something that's been being done for quite a while. I believe it started in the 70s, where it was an option. So they came up, because we've talked about shorting stocks before. So if you short a stock, you borrow one and sell it, and you have to buy it later, okay? Well, you can't directly short mortgages. It doesn't work that way. There was not really a way to do that. And so what they did was they started using something called a credit default swap. So when you default on your credit, that means that somebody who loaned you money, who owns who has given you, so you buy a house, you take a loan out from the bank gives you the money to pay for the house, you pay the bank back so you can live in the house while you're paying it off.
Yeah.
Well, to default on that means that you're not making the payments anymore.
Yep.
So one of the things that a lot of people did not realize had such a huge implication in what was going on was the subprime lending crisis that happened. So this was something that I believe was put into play by during the Bill Clinton administration. I don't remember the exact years that it happened, but I believe it was the late 90s that the subprime lending started happening. And so what that turned into is essentially most of the mortgages that you're used to seeing are what's called a fixed rate mortgage. And so you sign a mortgage agreement with your bank that says, I am going to borrow this money for 30 years at 5.35% interest. And that's the rate for my entire loan. So 30 years goes by, and my last payment has the same interest rate as my first payment. Well, these subprime loans had a lot of them had what's called a adjustable rate mortgage. So you got the mortgage rate that was available at the time, but it was not permanent. And so when mortgage rates went up, even if it was by a significant margin, you had to pay the gap whenever they went up. So if you started out with a loan that was at 5% and the interest rate after the adjustable rate kicks in jumps up to 15%, it could almost double your house payment.
Jeez.
So you can see where the problems are coming in. So there's a lot of different things that are happening that just created kind of a perfect storm of a mess. So these credit default swaps is essentially a insurance on the mortgages. Mm-hmm. So what they did, they created an insurance policy to state if the people inside of these mortgage-backed securities don't pay, then we get the payout. So think of it like, go back to car insurance is a great example. So you pay for car insurance on the off chance that if you're in an accident, that it helps you cover the bill in case it's higher than what you can afford. Same thing with health insurance. You go to the hospital and have to have surgery. You have health insurance to help mitigate the cost of that accident, even though you don't know whether it's going to happen or not. But what happened was the three main people that made the biggest amount of money off this which was the three main characters. Well, it's technically four, three main groups that went into and made the biggest amount of money in this situation was Michael Burry. And then there was another guy. So Steve Carell plays this character, but that's not actually his real name. They changed his real name. Ryan Gosling was largely based on a real person. It was the same kind of situation. They changed his name. And then there was another smaller hedge fund that was two guys. I think it was called Brownfield Capital or something like that in the movie. And the actual name was like Corning Capital or something like that. Anyway, so the long and short of it, there was quite a few things that happened all in like a rapid succession that essentially created like a domino effect. So obviously subprime was part of the problem. So to maintain the supply for these bigger banks, the smaller banks were literally eliminating their verification for what would allow people to buy a home. So normally you go in and fill out an application and say, okay, this is how much money that I have. This is what job I work. This is how much is in my bank account, all of that stuff. Well, they turned it into a system where these smaller banks
do you have a pulse?
Didn't care. Yeah, they called them ninja loans. No income, no job, no asset verification at all.
Oh wow.
And they didn't care because the reality was, because of how these collateralized debt obligations were being packaged and rated at AAA, all they had to do was get the mortgage signed, and a small bank could literally have the paperwork signed for a mortgage on a Friday, and by Monday it would be in a CDO at a big bank. So there was no risk at all to them.
Jeez.
So obviously you can see how some of these things are starting to cause some problems.
Yeah.
Yeah. So there was the subprime saturation. To maintain the supply of mortgages required to build CDOs, lending standards were eliminated. Loans were issued to individuals with no verifiable income or assets. None. Then they got put into adjustable rate mortgages. So many of these subprime loans featured variable interest rates, which, when introductory periods expired, rates reset significantly higher. Then what happened was called the default cascade. So borrowers could not afford the adjusted premiums, so the mortgage defaults surged, which is where the credit default swaps came into play.
Right.
So the supply of foreclosed homes flooded the market, causing housing prices to plummet. Because the CDOs were highly leveraged and intertwined, because it was tons of different houses and different banks and things like that that were all just intermingled into these collateralized debt obligations, the foundation collapsed because it was built off of a huge portion of B and triple B bonds, and they were not getting enough money to fill up even the triple A rated bonds or CDOs. So it rendered the securities functionally worthless because, essentially when you had that many people that were just not paying their mortgage, it didn't matter if they were Bs or triple As, they weren't getting paid.
Right.
Or they weren't making enough to cover it. So long story short, what happened was, after a long time of these big banks essentially committing fraud, like that, there's no way around it. They were straight up committing fraud. So what they were doing is they were lying and telling these the ratings agencies, they were telling them to rate these CDOs as triple A rated CDOs so they could sell all of their CDOs on their books, and then they were going out and buying the insurance on them. So they were lying about what they were buying, but they were trying to get in a position where they could basically cover themselves because the assets had lost so much value. So it was essentially, I'm going to take a hit selling my CDO so I can get into the position to pay for the credit default swaps, so I make the money that I just lost back. So it was essentially just whoever was left holding the bag. And it was the biggest bag of human excrement that has ever been concocted in the real world. In the United States. It got close to the level of impact that the Black Friday did in 1933.
Yeah, something like that. I remember all this nonsense happening.
Yeah, I mean, just
it's pretty bad.
So the real world economic impact was the U.S. household wealth dropped by $11 trillion, falling from $61.4 trillion in Q2 of 2007 to $50.4 trillion in Q1 of 2009. So about 18 to 21 months. The market contraction, the Dow Jones Industrial Average fell 53% between October of 2007 and March of 2009. That is significant.
I would think so.
Yeah, that's that's like basically if you had
like a lot.
Yeah, if you had a grandfather that was retired at that point, he had to go back and get a job because half of his value vanished. And the reality is what made it worse is people started panic selling. And so it probably exacerbated the problem for them. Whereas if they'd have held on to the stocks and things like that they'd invested in, they probably would have recovered most of the value that was lost. But it was just such a everybody panicked Armageddon kind of situation.
Like the toilet paper during COVID.
Exactly. Yes. Although, it's very funny to me, and I don't know if you noticed this where you live, but during COVID, I couldn't help but notice that every time I went to Walmart, that as much toilet paper was gone, there was always Angel Soft. It was like, you know what? It may be the end of the world, but I sure as shit am not using Angel Soft. I wish I could have taken a picture of the Walmart here when that was happening, because it blew my mind. Like every time I went to Walmart, Charmin gone. All of that just gone. Not like there's not even a sticker left. And then a whole section of Angel Soft. And I'm like, what's going on here? The great value stuff was selling before Angel Soft did.
Yeah, at least it's not like a perishable good, right?
Exactly.
Like
yeah.
Unless you put it somewhere and it gets wet, like it keeps.
Yeah. Like
here, you want to hear a ridiculous stat right now?
Sure.
During the pandemic, week over week in March 2020, toilet paper sales rose 845%.
That
in
does not
1 month.
Me. Yeah. So here's a fun fact.
$1.45 billion in sales, which is 112% up from the previous year. Man.
Yeah. So here's a fun fact. So I don't know if this was happening where you were, but there were people that were literally trying to scalp toilet paper in our area. So they would go into the Walmart, they would buy it all, and they would literally be parked in the parking lot trying to sell it for double what they paid.
Just by Angel
And what
Soft.
was funny about it is there was no actual shortage of toilet paper. So I don't know if you knew this, but I work with a couple different people who were in logistics at the time, and they were telling me about the specifics of what was actually happening with the supply of toilet paper. And it was not that there was a shortage. It was that people were panic buying and buying more than they normally do. And a lot of people don't understand how Walmart and Target and all these big stores know how to stock how much they have. They have advanced models to know exactly how much to ship to exactly which store. And it's pretty incredible how close they are as far as accuracy. They're typically within 5-10% on any given day. But when it goes up to 50% spike, they're going to have way too much. Like, it's going to be gone. And that's what was happening at stores all over the United States, is these people were just panic buying, or these douchebag scalpers would go buy out all the stuff, fill up the back of their truck, and they're like, oh, you need toilet paper? I've got Charmin Ultra here for, twice what you would normally pay, but you've still got some. And so what was hilarious, they Walmart actually enacted a policy, and this, I'll be the first to admit that I'm not super jazzed about Walmart most of the time, but this was one of the things that I was like, yep, Walmart, you did the right thing here. They passed the policy that you could not return toilet paper for like a year or a year and a half because they found out that people were scalping the toilet paper in the parking lots. And so they would not allow you to return the toilet paper after you purchased it. And so I saw a video of this lady who had her entire garage full of toilet paper. And she's like, yeah, I don't know what to do with this because people won't buy it. Duh! They found out you were trying to screw them over when the world was ending. Or at least when we thought the world was ending. You know, that's COVID for you.
Gee.
Yeah.
I
So,
but
yeah. It's,
I don't have any words. I
Yeah.
have no words.
yeah. So,
What a strange time
oh man,
is all
no
I
kidding.
will say.
Yeah. And so anyway, back to the
Sorry.
No, you're good. The Big Short. So Michael Burry was one of the earliest ones to do the credit default swap, and he actually started like literally going through the actual mortgages and looking at the applications that had been filled out. Like he went through it in extreme detail to find out what was going on. And this is how he was one of the first ones. But the problem was, in order to create the insurance policy, he had to, you know, it is what it is from an insurance perspective. You have to make the payment.
Yeah.
So
Right.
the insurance premiums were eating him alive because he was one of the earliest ones to do it. And because of that, he had been paying for a very long time, because I believe he started the ones that he got sometime in 2007 before there was even any rumors about stuff like this going on. And so obviously when you're the first one there, everybody else is wanting to make sure that the system stays the way it is. And so, you know, he had to fight with them tooth and nail. And I believe he put $600 million in because he was managing an enormous hedge fund at that point. And the movie doesn't really allude to this very clearly, but he was already pretty wealthy by that point. He's actually a PhD doctor of medicine, and he decided to quit because he had figured out a pretty good way of making some money from a investment strategy perspective. But the problem is he was building it based on being able to make small enough moves that it did not impact the market that he was investing in. And the issue was with when you get to a certain size, you're just by making a move, you're going to impact the market. And so that was when he kind of changed the scope of what he was looking into and moved into the mortgage-backed securities. And that was when he did the credit default swaps. So I think it was in the realm of about $600 million that he paid for these policies. Now, it's not that he went in and dropped $600 million in
Sure.
these policies. They
that would
set
be
it up and they
insane.
give you a premium. Well, the problem is and you watch it in the movie as well. He's talking about the amount that the premiums are costing, and so each month that goes by, or you know, each amount of time, because the movie is set up to be around, you know, about a year and a half worth of time, and so I think the last time he updates the number before everything gets valued appropriately, I believe he was down 197% on his investment portfolio. So he was basically liquidating other assets that he owned in order to cover the insurance premiums. And then the final clip of the of what he's doing, he updates the number, and he ended up, I believe it was 4 times return on investment. I think it was 400 and some odd percentage, but 4 times the 600 million basically. And so obviously he made the right move, made a killing, because the way that his pay structure was built, it was 2% of gross assets that he manages annually. So at 600 million, he would be receiving, let's see. Okay. I'm gonna have to do some math because my brain is a little bit too hot. No, so that's just 6 million. So let's put one more zero on there. One more. There we go. Okay, equals that times 0.2. So he was getting paid $12 million a year, I believe, but he was also getting them an average, which is why he was managing so much money. He had been getting them an average of like 25% return on investment for the last 4 years, which is incredible. If you do 14%, you're doing very, very well. And he was doing almost double that. So, from an investment strategy perspective, these people were making a killing off of him for 4 years before this move. And after that, he would have been valued at, if I'm doing the math correctly, and the premiums were at 100% of what the policy for the credit default swaps paid out, it would have been over $2 billion. And his pay would have jumped up to just a tiny little $48 million a year. But I mean, he had people threatening to sue him, to throw him in jail, to nail him for embezzlement and all this other stuff because he came up with he was doing these credit default swaps, and they were just losing it because he was paying these premiums, and there was never any signs, because all the banks and the credit agencies were in cahoots together and lying to each other and for each other. So these things would be valued at what they wanted him to be valued at. But the two guys that were like basically your garage investment firm, they actually made the most shrewd business move. So they actually did the credit. So Michael Burry and the Steve Carell character, I never can remember his name. I think his name is Mark Baum or something like that in the movie. They shorted I think they shorted the Bs and the triple Bs. The other two guys, they actually ended up shorting the A's, which that was essentially, so the cost of the premiums was directly correlated with basically the risk of that happening. So if you short something that's the most likely to happen, which is shorting the B's, that's, you're going to pay through the nose for that. But the A's and the triple A's, which is what the other two guys ended up shorting, they're like, oh yeah, we'll take that bet all day long, because the banks viewed it as essentially getting free money for an insurance policy that they didn't think they were ever going to have to pay out. So it was like 100 to 1 from an investment strategy perspective. And so I think they ended up coming out of it with like $75 or $80 million from a $2 or $3 million gamble, so to speak. And so, yeah, it ended up making these guys a lot of money, but everybody else lost their shirt. I mean, it was insane how much money just vanished. The U.S. economy lost 8.7 million jobs. The unemployment rate doubled. Yeah, like it was insane. So, but the reality is there was not really anybody that went to jail, even though they should have. It's kind of like what we talked about with the Wolf of Wall Street. Like, they got basically a slap on the wrist and told that you shouldn't do that, and then the government bailed them out because they deemed them too big to fail. Yeah,
too big to fail. That's nonsense.
Yeah. And I mean, they were literally committing fraud to do all this stuff. So the corporate financial penalty, which They did have to pay something. So the Department of Justice primarily
thank
utilized
goodness.
Financial Institutions Reform, Recovery and Enforcement Act, called FIREA, which sounds like a fiery diarrhea, which is basically what it is.
Does.
And this was
Taco Bell.
Yeah, exactly. This is the Taco Bell Act to secure civil, to secure civil settlements from institutions that packaged and sold toxic residential mortgage-backed securities. And that means like they were selling dog shit and they knew it was dog shit and they were telling the people that they were selling it to that it wasn't dog shit. So what they did was,
I mean, isn't that every like 80s and 90s
yeah, pretty much.
toy commercial on TV?
I mean, it's so much worse than that because it's not like this was a little bit of money. It was like, hey, I'm going to sell you a car, but it doesn't have a motor. And the seats are made of cardboard. And when you put the key in it, it blows up and kicks you in the balls.
Oh.
Yeah.
Now you're talking my language.
Yeah. So what they did was they did aggregate fines. So the global financial institutions paid an estimated $150 billion in fines to the U.S. government regarding their roles in this mortgage crisis, which is why I think this is when Bernie Penny May and Bernie Mac or whatever, Penny Mac, whatever, those financial institutions for the
Fannie
government.
Mae.
Yeah, Fannie Mae, yes. That's when they kind of got way bigger because they essentially I believe to an extent they absorbed some of these mortgages into them and restructured some of them so the people that could still pay their mortgages got to keep their house. But yeah, it was a mess. I will have to confirm that though, because I don't know exactly when they rose to the prominence that they are today. But the major institution settlements. So Bank of America was the biggest. $16.65 billion settlement in August of 2014. The largest civil settlement with a single entity in American history. J.P. Morgan Chase reached a $13 billion settlement in November of 2013. Citigroup, $7 billion. Goldman Sachs, $5.06 billion. Morgan Stanley, $3.2 billion. So those were the top 5 big players in the. We hosed so many people that we had to pay back a small percentage of the profits that we made out of that. And notice how Bank of America is still pretty damn big, and JP Morgan and Citigroup and Goldman Sachs and Morgan Stanley all still big. Yeah.
Yeah, it was a wealth transfer.
Exactly. And they had to give back the interest off of the wealth transfer. Not the wealth, just the interest.
This makes me so glad I pay taxes.
Oh man. Yeah, ain't that the truth? So there was a couple other things
bullshit
that ended up happening, but nobody went to prison.
Boo.
Yeah. Which it's like, okay, to an extent, I understand that the level of damage that was done was so high by so many different things. It's like, okay, if we arrested everybody that took part in this, it would be 15,000 people in jail.
Fill them up.
But well, yeah, listen, they
fill them up.
And the problem is, I can understand it from a perspective of if they didn't realize what was going on because they were being fed bad information, that's one thing. But yes, I don't disagree. Yes, fill them up.
Fill the jail cells.
Yeah, yeah, no.
Yes.
I don't disagree with you in any capacity. But yeah, the institutional settlements were divided between civil monetary penalties paid to various government agencies and mandated consumer relief, which is where my problem is. It's like, okay, this was a medium that was created that screwed so many people out of money and their homes. And the penalty goes where? To the government. Now, not all of it did, but this is the real kicker for me, which is what's insane.
Fill them up.
Including with the government officials that got the kickbacks for this crap too.
Fill them up.
Consumer relief allocations of Bank of America's $16.65 billion settlement, $7 billion was earmarked for consumer relief.
What does that even mean?
So,
because I didn't get any of that.
Well, so it was the total settlement was 16.65. The $7 billion was essentially put into basically probably what's called like a class action lawsuit, that anybody that was part of the bad happenings that were created by the CDOs and things like that Bank of America had, they got a piece of that $7 billion. The rest went to federal and state entities. So of the 16.65, less than half went to the people it was taken from. The rest went to the government. Of JP Morgan Chase's $13 billion, $4 billion was allocated to consumer relief. So $9 billion went to the federal and state governments, and $4 billion went to the people that it was stolen from. The relief mechanism.
You're making me angry.
Oh man, yeah,
this is making me angry.
It should. Many people should be in jail for this. So these funds were directed towards principal loan forgiveness for underwater homeowners, delayed foreclosures, loan modifications, and community development funding. So people who owned the loans that were part of this stuff, they had the principal reduced. So let's say they had a loan on a house that was overstated by a significant margin because the house just wasn't worth that much. So they said it was worth $500,000 and it was actually only worth $250,000. That money went towards reducing that value from a principal perspective.
I feel like in a case like this, you should just get the house for free.
I don't necessarily disagree with you.
Like, you know, if the Starbucks employees screwed up your order so badly, you go back and you demand another one for free.
Listen, I bought a house.
You know what I mean?
You dick bag. And you set it up to where my payment was originally $600 a month, and it jumped up to $1,200 and no, actually probably closer to like $1,800 a month. I don't even make $1,800 a month. It's 2007.
Yep. How do you expect me to pay this? You effed up. You get to eat the cost. I don't care if you go bankrupt. The house is now mine. Give me the pink slip and fuck off.
Yeah. Hey, you heard it here. Pink slip and fuck off.
Exactly. See, this is my problem. Like, these big banks, they're too big to fail. No, they're not.
No, they're not.
No,
they
they're
should.
not.
Yeah, there's no.
They should fail.
The market will adjust.
If they're going to engage in deceptive
fraud.
and
Straight up fraud.
let them fucking fold.
Yeah. Yep. 100%.
And have somebody else take their place that won't fuck around with the people's money and lives.
Yep. Yeah. I mean, and to watch how this stuff unfolded, it's one of those things that it really is eye-opening to how bad things really are. And you know, I've kind of thought to myself a lot recently that things have just gotten so much worse. This was 20 years ago that this crap started happening.
Holy shit.
Yeah.
Freaking old.
Yeah. No. Like the stuff that created it was happening between 2000, you know, the year 2000 and 2006. Like, you know, it was kind of a snowball effect. But I'm looking at the you know, the calendar. I'm like, man, it's 2026. This was almost 20 years ago that this shit sandwich got shoved down everybody in America's throat. And they got bailed out of it. So there was also limits of restitution. So the settlements did not offer full financial restitution to individual retail investors or to the majority of the 6 million displaced homeowners. The penalties functioned primarily as punitive damages remitted to the state rather than complete indemnification for affected consumers. So yeah, the state didn't get reamed, but they sure got the benefit for it. The state and the federal government. So yeah, it's insane.
And I don't know, how the hell does that make sense? Because the government is going to take that money and it's not going to go back to those people. It's just not. It's just not.
It's going to go to nonprofits that all their buddies and cousins and brothers work at. And they're going to give them these stupidly obnoxious $20 million a year salaries because they're
you and I are in the wrong business. We're in the wrong business, man. We should just become fraudsters.
You know,
apparently it's a win-win.
Yeah. But you got to be in the right
Minnesota.
Yeah, well, right state or right state of family
of mind.
You got to have the right. Yeah. So yeah, it is. I hear
ridiculous. It's big business in California too.
It's a big business in every state. I can guarantee you that. Like I would bet everything. I would go take out a third and fourth and fifth mortgage on a house that I don't own and bet all of it that there is a significant amount of fraud in every state in the United States. To the tune of, I would be shocked if it was less than 10% of the state budget. In every state. I got to be careful. I got a window that's, looking outside. Make sure that I'm ducking behind my computer monitor every once in a while.
Are you trying to avoid the snipers?
Yeah, exactly. If you see a little laser pointer on my forehead, let me know so I can duck out of the way.
That's fine. I'll do that. Just give me your social security number first.
Yeah. You want to get all my debt?
No, I'll just use it to commit fraud.
Oh yeah, of course.
Like Medicare fraud or something in your name.
Yeah, you can get my Social Security benefits until I'm 197 years old.
That's a great idea, but I would have to be older than you at that point.
No, you wouldn't. Just put it into a trust. So yeah. But in all seriousnness, and I know that we got into the weeds as far as like there's a lot to unpack there, and trust me, like I said, I have watched. I love that movie. I've watched it at least 10 times, and it's a very entertaining movie. I've read article after article about this stuff and done research even just on the implications and trying to understand what it even means to have a collateralized debt obligation and things like that. And the more I research it, which I probably should do it in the beginning of the day when I'm not exhausted, rather than at 11 o'clock at night when I've used all of my brain capacity for the day.
Which isn't much.
Yeah, exactly. But yeah, it really is. It really is a doozy. So if you ever get a chance to watch The Big Short, now you'll be at least slightly more educated on the realities of what was going on, and yeah.
Wow.
Yep.
Wow.
I do think one guy went to prison for like a year or something like that.
Oh man, that makes me feel so much better.
Yeah.
That makes my parents losing their house just takes away that.
Yeah. Yeah. Did they really lose their house?
Yes.
Wow. Man. Yeah. That's the crazy part. Is it's not like this was in 1924. I don't even know anybody that's still alive from that era. You know, this happened to people that you know. 6 million people lost, 6 million homes lost. That's insane. And the government got the kickback for it. That's even more insane.
Like, when you look at the details of these things, like, it's hard for me, and I know we don't get into politics in the show, and I don't want to.
Oh, yeah.
But the more that we look into, like, tax and money stuff and, like, how the government spends our money, right, left, Republican, Democrat, I think we can all agree the government sucks at its job, and they waste my money, and that pisses me off.
Yep. Yep. I just can't imagine a world where I have been audited for seven or 8 years in a row and been unable to pass the audit and could not explain where an enormous, comically enormous pile of money went.
Yeah, yeah.
For every one of those years, and still keep my job. Like, hey, yeah, we lost that $1 trillion again. We don't really know where it went.
I'm sorry.
What's
again?
this we crap? I don't know where it went.
You lost.
Yeah.
You're fired.
Yeah, exactly.
And you're probably going to go to prison.
Exactly. Yep. Yeah. If you do not need to be able to go out in public if you are doing bad enough at your job to lose the amount of money that they've lost 7 years in a row. You are a danger to society.
I feel like it's one of those things.
Wait, what? What? No.
Yeah.
That's not a sentence you should say.
Right, exactly. But it's just the thing. Like, I feel like it's too abstract sometimes.
Yeah.
Like, people don't always visualize it, or that's what I'm looking for. Scheisse. They don't always like conceptualize it as like life and death. Because like for some people, like, you know what, it can be incredibly impactful, like life changing, and it's it's just $1 million. Like, bitch, I could live the rest of my life on $1 million.
Oh yeah, easy.
Like, and never have to work another day in my life.
Yep.
Like that is what that means. So it's like, you can't tell me that like these are like victimless crimes. Like, people went out on the streets. Oh yeah. You know, and we've got a we got a huge problem.
There's a family. This guy is so Steve Carell's character, they're doing research into ways to confirm that this housing bubble is actually a bubble. And they go down to, I think they're in Florida, going around to these different communities and basically just going door to door and knocking and talking with real estate agents and driving through these neighborhoods where there is a for sale sign in every yard because these people are trying to get out of these houses that they can't afford the payments on. And he knocks on this one guy's door, and the guy's like, well, hey, I pay my rent every month. Am I going to lose my house? And he's like, well, what are you talking about? Like, you know, do you not own this house? No. I rent it from such and such. He's like, well, you should probably talk to your landlord because they were investigating houses that were over 90 days delinquent on the house payment. And so they just literally got a list of them and went and knocked on the doors. Because it was all publicly available information to the banks. You know, they can go look at what's in these mortgage-backed securities. It's got the details in the information. You know, it shows this is the mortgage, and this is who the house is owned by, and this is who the mortgage is through, and this is how much they're paying, and this is what their monthly payment is, and all that stuff. So, but yeah. So, although it is, which this is kind of a little bit of a subject change, but I did learn something kind of fascinating. I thought you might like this because we're talking about, you know, these wealthy people and poor people and how this stuff impacts them and stuff like that. So, there has been not necessarily a causation, but there's at least a correlation that's been discovered recently that wealthy people tend to have more tend to have more peanut and tree allergies in their kids.
Serves them right.
Versus poor families tend to have more shellfish, what was it? Shellfish, and there was a couple other things. Allergies. And I was like, well, that's kind of fascinating because one would assume that, you know, a poorer family would be able to eat. Oh, it was soy. So shellfish and soy. So poor people are not giving their babies formula, which is often soy-based. Not always, but often.
Right.
And they're also not going out and eating crab and lobster. But rich people are not eating peanut butter and jelly sandwiches.
What's wrong with
or going outside and playing in the trees, you know.
Rich pricks.
Yeah, so I thought that was kind of fascinating that there seems to be a significant correlation between the amount of income a family has and the likelihood that the children in that family will have specific allergies.
It's very interesting, actually.
Yeah.
No, it actually really is very interesting. Yeah, I'm glad my kids are. I mean, I don't think they're allergic to soy.
Yeah.
But hey, I mean, even if they were, I'd be glad for it because then they won't grow up to be pussy ass bitches.
And there you have it.
And there you have it, folks. Besides, soy gives you man boobs.
Yeah. If you overdo it,
true story.
Don't
True
do
story.
too much soy. You have to do just the right amount. Listen, I am a sucker for what are those stupid things called? Chick patties. Morningstar chick patties.
Gross.
They are not as good as they used to be. I will say that.
Put some
Whoever
meat
over
in your
at
mouth,
Morningstar
Clint.
changed that recipe, you are a monster. Go back
Put
to
some
the
meat
old
in your
recipe.
mouth, Clint.
You
like
know
a
me.
real
I
man.
eat meat all the time. But every once in a while, I'll delve into the veggie food.
Gross.
Yeah, I know.
Overloaded with the sodium.
Oh man, processed to hell. Yeah.
Dude, I remember back in the day when I was a kid, like everyone, everyone's like, "Oh yeah, being vegetarian is so much healthier," and I'm like, "And if that, it's not." I could eat 2 steaks a day and be twice as healthy as 1,000 vegetarians.
Probably. Depends on what kind of steaks you're eating.
Only the best Omaha steaks, of course. Actually, I don't know if I've ever even had Omaha steaks. It's just what everyone always says, Omaha steaks.
Omaha. I eat my steaks Yamaha style. Yamaha makes everything. They make pianos.
Yeah.
They make cars. They
do.
make motorcycles.
They do,
and they
yep.
make the best damn steak you've ever tasted.
I'm looking this up.
I have no idea if they actually make any steaks, but they make everything else.
Steaks. Oh, man, I'm sorry to let you know. I don't find anything for Yamaha steaks. I do see Omaha steaks. Google, actually, it's Brave. That's why I'm using the Brave browser, and
Oh yeah, and it also always.
I don't think
defaults to
Brave search.
It's
Yeah,
not.
I don't
It's
think
not
Brave
quite
search
there
is
yet.
good. Steaks.
I mean, eventually,
Yeah.
people are going to stop using browse or search engines for anything, and they're going to be using AI.
Okay, well, it looks like there is a viral TikTok trend about Yamaha steak.
I had no idea that was actually a thing. I was literally just making things up. How much are they? Let me see if I can guess. $22.
No, yeah, wrong. The price is wrong, bitch.
Well, I failed this week.
It's actually a recipe.
Oh, okay. Do you cook it on the back of your
So-
piano? Like, is that how you
No,
tenderize it
on-
with the when you're hitting the piano keys?
Yes.
You smack
You
it with
put
a
it-
hammer, and then you have to
Yep,
redo
exactly.
your own piano.
And then you gotta take your Yamaha Ninja and get to the
Get exhaust pipe really high.
the muffler.
Yeah.
Yeah, and then you just
Yep.
slap it on there.
Yep.
There's actually a Yamaha plant here in town where I live, and they make shit. I probably just gave away where I live. They make
Hey,
Like
viewer,
trains.
Don't go to Ricky's house.
yeah. Don't go to my house. To get met at the door with a wireless hole puncher. They make the train cars for like city transit stuff.
Oh yeah, I got you.
I don't know what they call those pussy ass bitch stuff. I can't get a car. That's what it is.
Oh man,
I can't drive myself because I don't have a license because I'm a stupid weak ass city folk.
you can't drive. What
No, I
happened
can
to your-
drive,
What happened
'cause
to your
I'm
canary
not-
yellow Audi?
I have it still.
Oh.
I know that's what I'm saying. Is that if you
I got
those people that live in the cities and go on public transit, they skinny jean wearing, soy latte drinking, chick patty eating.
Hey,
Yes.
hey, chick patties are delicious. Have you ever had one?
There's a lot of things that are delicious, Clint. Uh-huh.
Go on.
Yes, I've had a chick patty and it was gross. Every chick patty I've had,
come
I have
on.
regretted putting in my mouth.
Oh,
No,
come
I'm
on.
serious. I do not like them. I don't like them.
You're expecting too much out of it. You at
Well,
least
then they
like-
shouldn't name it chick patty. That's the
It's
part of the
not
problem
chicken,
is they give it a
it's chick
they
patty.
give it a meat. It don't no, it's too close. They give it a meat-like name. You got it. You're setting an expectation, and you're failing frickin' miserably.
Yeah, you're not wrong.
I know. They're gross.
Well, that's all we have for the Big Short this week. But if it makes you feel any better, I think there was one person arrested. Okay, one guy was not even in Wall Street. It wasn't one of the bigwigs. His name was Lee Farkas.
There's a name.
I believe he was related to Scott Farkas from the Christmas Story. The guy, he has yellow eyes and beats up Ralphie and his friends when they're on their way home from school every day. He's got the
Is that real?
raccoon. No. Wait, you've never seen Christmas Story?
I've seen it. I just don't remember everything.
Well, the kid that bullies him all the time is Scott Farkas.
Oh, Scott Farkas. I typed the wrong thing.
Yeah, the Scott Farkas affair. So this is the Lee Farkas affair. He was the former chairman of the mortgage lending firm Taylor Bean.
It's Gut Farkas.
Scott?
Yeah, in the movie.
I thought his name was Scott for...
No.
Wow.
Scott Farkas is an attorney at law and principal member owner of Alperstein, Simon Farkas, Gillian, and Scott, a Los Angeles-based law firm.
That just shattered my entire universe.
You're welcome.
Okay, well, yeah, I needed that.
There's actually a lot of Scott Farkases.
So, Taylor, Bean, and Whitaker was the firm that he worked at. He was arrested and sentenced to 30 years in federal prison for orchestrating a $3 billion fraud scheme, which is largely what these other ones did. They just didn't go to prison for it.
So he was a patsy.
Yeah. Which is what's even funnier is he wasn't on Wall Street.
That's total bogus nonsense, man.
Kareem Sarah Geldon, a former executive at Credit Suisse, was the only top Wall Street banker to serve federal prison time, 30 months for actions directly related to the crisis. Ralph Cioffi and Matthew Tannen, two former Bear Stearns hedge fund managers, were arrested and indicted for securities fraud in 2008. A jury acquitted both men of all criminal charges in 2009, which means they were paid off.
That's BS.
BS. In a slightly related note, Iceland, the Icelandic government arrested and prosecuted high-ranking financial professionals.
Good.
Yeah, so way to go, Iceland. Nice job stepping up and at least sticking it to somebody that was part of this crap. 36 banking executives were convicted and sentenced to a combined 96 years in prison for market manipulation and breach of fiduciary duties. So, good for you, Iceland. Good for you.
Yay. About frickin' time.
Yeah. The Federal Bureau of Investigation did conduct multiple large-scale sting operations targeting lower-level industry participants, including mortgage brokers, real estate agents, straw buyers, and appraisers. Operation Malicious Mortgage resulted in 406 arrests in June 2008. Operation Stolen Dreams resulted in 485 arrests in 2010. All lower-level industry participants, not the guys who were giving the orders. Anyway. So, on a lighter note, do you have a Going Deep segment for us today, Mr. Dick?
And I want to go deep to the bottom of a bottle after this topic.
Yeah. You know, as I was doing my research and looking into this stuff before we got on here tonight, I kept getting more and more angry because the movie does a pretty good job of depicting what the specifics for the three specific groups. So Michael Burry is one investment, because it's talking about it mainly from the perspective of the amount of money that they made off of what happened. So you're kind of looking at it as like these guys were the winners from the situation that was created. So it's got Michael Burry's group and then Steve Carell's group, and he has 4 or 5 guys that work with him that do analyst work and stuff like that. And then the last 2 guys that are kind of the guys who do it out of their garage, and they're the ones who are, I believe they're neighbors or something like that with the Brad Pitt character, who's kind of gone off the wall, like conspiracy theory kind of stuff. But anyway, it's an interesting perspective about how they made their money off of it. But as I'm looking into the realities of what actually happened and where the fraud was committed and all this stuff, it just made me more and more angry. So so yeah.
Yeah. Bullshit.
So, do you have a going deep segment for us today?
Nah, man, I'm ready for bed now.
Yeah.
Nonsense. I'm still getting over being sick, and I'm not feeling really good, so.
Yeah, no, I get it. It's been one of those weeks for me too.
Ugh.
Yep. But yeah, so well, I know this is going to be a little bit shorter of an episode, and I know I'm a little bit behind on getting things uploaded, but we should be getting 2 episodes. So if you've made it this far into the episode this week, thank you for watching both episodes this week. But
yes, thanks.
yeah. So yeah, we'll get a great big going deep segment for the next one, and
yep, definitely.
Thank y'all for stopping by, and remember, today is another day, so
go out there and make it a great one.
Yeah, there we go.